Hello guys and welcome to another video. My name is Mark, I'm an entrepreneur and property investor, and in today's video we're talking about the Halifax House Price Index and the fact that it has just come out and reported a 0.2% to the downside for UK house prices in December. Now this report always looks back a month, so we have to bear that in mind, but it coincides with the sort of timescale it would take for any fallout from the budget to come through to house prices. Because what's happening now, certainly on the employment side, may affect things in the future. So if you like this sort of video, if you like this sort of content, please give this video a big like. It does help me out with the algorithm. And if you haven't already subscribed, please consider subscribing. Until I get to 10,000 subscribers, you can book a free one-to-one call with me, absolutely free of charge. I have nothing to sell to you. Look in the description, you'll be able to find a link for that there. Now guys, let's talk about this report. Let's talk a little bit about what's going on in the UK economy. GDP is not growing. We are not growing the UK economy. Bond markets have absolutely spiked, showing that international buyers of UK government bonds are charging a premium for Labour implementing this plan. And it's now got to the point where they may not be able to implement their economic plan, i.e. the public spending rises and all the infrastructure projects that they had planned, because their cost of borrowing that money is greater than the headroom they had in their budget. So this is a bit of a nightmare for any government to say, we're going to raise taxes, we're going to be able to do this, but now the markets have gone, no you're not, that we don't believe in that plan, we're going to charge you a premium for borrowing that money, and then they haven't got the money to do the projects in the first place. It's kind of the worst of all worlds. And this is why I love capitalism, because capitalism keeps politicians in check. It's not for the politicians to decide how much international markets are going to charge the UK for their debt. We operate in a global economy. Anybody can buy anybody's debt and say that we believe in your plan and we will charge you this much interest for it. It's not that anybody has anything against the UK, no, not at all. It's just that we think that that plan might not be as sound as the plan before, so therefore we're going to charge you a premium to do it. And that, as I said, is the beauty of capitalism. It all sorts itself out. And ultimately, if the government still believe that their plan is the right one, they will have to pay the extra amount of interest that the lenders are charging in order for them to do it. And if they do that, then, as I said earlier in this video, they may not have the money or the budget in order to implement the plan. So we may see higher tax rises. Now, obviously, coming into government and saying that you're not going to tax working people, and in the very first budget, you stick a nice big employers, not working people, national insurance hike on, we all know, and I'm not a politician, you guys know that if you tax the employers to employ somebody, then that is going to have a knock-on effect on the cost of wages. Of course, it is tied up to that staff salary. When I'm looking at my staff's budgets, I look at the staff pay, I look at any benefits, I look at the pension contributions, and I look at the employer's NI. That is the cost of that member of staff. Nice and simple. Every business does it the same. So to say it's not a tax on working people is an absolute fallacy. And you guys know that you're being lied to, and you probably find it as laughable as I do. But guys, that's the reality of what's going on there, that this tax is coming from working people, and that is making people a little bit nervous about their future. Couple that with the jobs data, and the UK is posting less vacancies than it has for many, many years. I think vacancies are shrinking. I think the data I saw was vacancies are shrinking at the fastest rate that they have in over a decade. And that makes sense to me, because in my businesses, we're kind of like, we're not going to hire anybody at the moment. We were advertising for vacancies pre-budget. We're now like, well, let's see how things shake out. And a lot of businesses are doing the same. Let's be clear, this extra cost on us is only the equivalent of about one member of staff, right? That's the additional tax. But we would have employed that other member of staff, and now we're thinking, well, maybe we could do without. And that's playing out across the entire economy. Couple that with a minimum wage increase that's coming into force in April, and businesses that are operating in the retail sector, the restaurant sector, with fairly low paid workers, those are also cutting back. So we're seeing this big pullback from businesses investing in staff. Now that could obviously lead to a raise in unemployment, and that's a risk for us investors as well as as people who are out there working those jobs. But what I'm seeing overall and what I'm hearing anecdotally from people I speak to is that there really is two camps. The investors are not that scared of this. They are thinking, well, as long as I'm still buying below market value, i.e. I find a house for 100,000, I buy it for 85,000, and when I say I find a house that's worth 100,000, I mean its true market value is 100. Not that it was advertised for 150 and I got it for 100. No. Let's be clear, whenever I say this, I mean that its true market value is 100,000. Buy it for 85, I've got a lot of insulation in there. I would need a 2008 style issue to be able to go even into the equity that I have bought in by buying below market value, right? Even then, if I've got 15% already in it and the biggest correction was 21%, I need that sort of style event. That was a global event that affected all markets. I don't see that on the horizon. What I see on the horizon, I think we've already gone through that, just to be clear. I think that the inflation crisis over the last couple of years was exactly a 2008 style event. That had this effect on the economy, if you ask me. We didn't grow GDP, but we had inflation of 20%. So over that period, essentially 20% in real terms has been wiped off everybody. So if you had a property worth 100,000 and it's now still worth 100,000, but 20% inflation took place, well, nominally you're no better off or worse off. However, real terms, you're 20% worse off. And that's what's kind of happened over the last sort of 3 or 4 years, if you ask me, is that we've kind of had this silent crash. So I do believe that there's still a lot of upside for UK property. I think these sort of political events and these sort of pullbacks are a great opportunity to get out there. If you ask me, the more negative the general public are, the more positive and optimistic I become, because I can then start to buy really, really good deals. COVID was a great example. 2020, I bought 3 of my best deals ever. I managed to get something that was worth about 350. I bought it for 275. I bought a property in Sheffield for 90,000 that was worth easily 115. Today worth 140. And all of this happened because people were just terrified of COVID and that house prices were going down, the markets were crashing, everyone was in this high state of shock that this is the end of the world. And I remember sitting there with my business partner and saying, either this is the end of the world and everybody's screwed, or nobody's screwed, and this is just one of the opportunities of a lifetime. And we both decided it must be the latter. There's no way that everybody loses everything. It can only be that everything will be okay, and this is the opportunity of a lifetime. And at that time, we bought quite a lot of stocks in, for example, my wife's pension, and they have gone up by 126% from the crashes of about April, May 2020. So, we made the decision that it was the opportunity of a lifetime, and really we have capitalized on that. Now, I believe that right now, as this pessimism starts to roll on, it may well be a great opportunity to get in there. But let me caveat that with one thing. I think it's a great opportunity for investors. For somebody going out and buying their own personal home, let's say, for example, you live in a 3-bedroom house, you were gonna move to a 4-bed detached, you were gonna have an additional 200, 300 grand of borrowing, higher interest rates, and now this uncertainty with jobs and everything. I think if you rely on a job, that's a terrible idea right now. I wouldn't be doing that. And this is where I think the opportunity comes in, because if you're an investor, even if you're an investor trying to start out and you've got a job and you're going to buy your first investment property, got to remember there's ways of mitigating risk. You can insure the tenant's rent and make sure that you're always getting rent. So if you're in the position where actually this could significantly hurt me if the tenant didn't pay and it's my only property, for someone like me who's got maybe 15, I always expect there to be an issue every so often where a tenant won't pay me, and that just works itself out in the wash. But if it was my only one and it would significantly hurt me if the tenant didn't pay their rent, then I might insure the rent. There are lots of ways of mitigating all this risk. So I think right now is the big time for people who need to secure their future to go out and start buying investment properties, getting them rented out, making sure that they secure money and positive cash flow coming to them every single month. That for me is a sound plan and strategy. And there are ways of doing it, as I said, if you can buy below market value, if you can negotiate a discount, you can mitigate almost every risk. This is the beauty of property investing. You can mitigate so many risks with insurance, with negotiating with sellers, all of these tools that are in your arsenal in order to be able to make sure that you can be successful in this. And I was speaking to a guy literally from one of these calls a couple of days ago, and he had about £300,000. And I explained lots of the tips and tricks and things that I don't necessarily have time to put out on YouTube. But he was like, why doesn't everybody do this? And I was like, because everybody doesn't have 300 grand in their bank account, mate. That's why. So if you're sat there and you're thinking, well, why doesn't everybody do this? If you can mitigate here and you can insure here, think about a stock. It's really hard to insure a stock against collapse, but you can insure a house against fire and collapse and earthquakes and natural disasters and everything else. So you've got all these tools in your arsenal to make sure that you can come out okay. Added to the fact that I think this is the key thing, right? Investors have to put down 25% as a deposit. Residential buyers can get down as little as 5 or 10%. How many people get hurt before it gets to the investors? How many people lose their homes and go into negative equity, and the whole economic situation becomes so unpalatable that big moves have to be made? Well, loads of people, all of those people who bought with emotion. I bought my new home because I loved it. I loved the position. The investor that just got a really good deal, well, he got 15% off and put 25% in. What sort of correction needs to affect him? It's got to be huge. So guys, that's why I'm still a big believer in property investing. And I know I've gone off on a bit of a tangent on this video, but I just don't think a 0.2% pullback in property prices is really worth us discussing in any big detail. In the same way that when property prices increase by 0.2 or 0.3, I think we need to look at long-term trends. Now, if this becomes something that becomes entrenched, and I do a video in next month and it's another pullback, and the month after and it's another pullback, well, I'm going to be demanding an even bigger discount when I come into the market. I'm going to make sure I get even more money off. But right now, if I'm getting 10, 15% off, buying smart, getting good tenants, getting good value for money, buying in the right locations is key. Again, if you look at this report, if you're buying up north, they're still growing. Of course they are. They're still very, very cheap houses. A 3-bedroom house for under 150,000. Are you kidding me? With national minimum wage at £12.50, whether you live in Oxford or Sheffield. It's a no-brainer of where the actual results are coming from. The data supports all of it. So guys, I hope you enjoyed this video. Let me know your thoughts down below. I will see you on the next one. I can't wait to connect with even more of you. Click that link in the description. Let's have some more chats, and I'll see you soon. Cheers, guys.